My name is Toby Dudley-Smith, Head of Coverage for UK and Ireland at Xtrackers. Xtrackers is the ETF arm of DWS and one of the largest ETF providers in Europe, with a long history in index replication which dates back over 25 years. We offer over 170 ETFs across a range of asset classes: equity, fixed income, money markets and commodities, letting investors implement a wide range of market strategies in a transparent, flexible and efficient way. The objective of the ETF very simply is to track the MSCI World ex-USA index, which is a global index reflecting around 30% market capitalization of the MSCI World, combining 22 developed market country exposures across the regions of Pacific, Americas, Europe and Middle East. Now, managing non-US exposure is complex for a number of reasons, particularly if you think about all the different countries and regional building blocks. So this basically allows investors a simplified allocation in what can otherwise be more difficult to access exposures. One of the consequences of such a strong US equity market over the last decade or more is that its weight within global equity indices have grown significantly in that time. And if we look at MSCI World Index today, almost 70% of the equity allocation is to US equities. So whilst an investor may believe they are buying a well-diversified global index, actually a large part of their returns will be hugely dependent on the US equity market. And what's more, if you look at the underlying names in the index, over 20% comes from the so-called Magnificent Seven, a group of major tech companies, including the likes of Apple, Nvidia, Microsoft, and Amazon. So concentration risk is an important fact investors need to be aware of, even when buying a market cap weighted global equity fund, tracking an index such as MSCI World. And so by excluding the US, it can help to reduce this concentration risk and enable to investors to have much more control over how they manage their US exposure. One of the benefits of taking a World ex-USA approach is that it provides more flexibility of how you manage your US equity weighting within your portfolio. So whereas, for example, in an MSCI World Index, the US equity weight is 70%, you might wish to dial down this to say 50% by having a separate US exposure versus World ex-USA. You might also be thinking about whether you want a purely market cap driven approach for your US investments, given the Magnificent Seven concentration risk, or actually would you prefer to take an equal weighted approach to reduce your exposures to these large tech companies, which is certainly something we've seen grow in popularity in recent years. Also, investors may consider utilizing a synthetic ETF for their US exposure, where it might be possible to generate additional outperformance versus a physical US equity ETF through withholding tax benefits. And finally, there can be some cost efficiencies by blending World ex-USA with a low-cost MSCI USA ETF. It may be possible to actually lower the average cost of ownership versus, let's say, investing in a standard MSCI World ETF. Yeah, as an equity ETF, the value of your investment may go down as well as up. And certainly being a global equity fund, you are exposed to underlying currency markets, which may be highly volatile and can result in your investment suffering a loss. It's also important to remember that the value of an investment in shares will depend on a number of factors, such as market and economic conditions, sector, geographical, regional, and political events. Aside from World ex-USA, another allocation tool that has grown in popularity is emerging markets ex-China. China accounts for around 30% of the MSCI Emerging Market Index, so not quite the same scale as the 70% US dominance that we see in MSCI World, but it's still the largest country driving EM performance. And with the ongoing geopolitical concerns and domestic policy, which in recent years has created heightened volatility, we have increasingly seen a divergence in performance between China and the rest of emerging markets, which certainly has fueled the desire for some investors to try and better manage their China risk. So by stripping out China from the MSCI emerging markets, it enables investors to have much more flexibility and ultimately more control in how they manage their China exposure. And anyone looking for further details on our World ex-USA or Emerging Markets ex-China can find these on the Xtrackers website or of course on AJ Bell's website.